What's up, guys? Welcome back to another episode of Behind the Facade. I'm your host, Gavin J. Gallagher, and on this podcast, I explore the mental and emotional game often playing out subconsciously, both in your mind and the mind of everyone else in the real estate or property investment market. The key to success in this game is to master your mindset and behavior, to take control of your thoughts, your emotions, and most importantly, your ego. Welcome to the show. What's up, guys? Welcome back to another episode. And as you know, I'm always on the lookout for opportunities, or I'm keen to learn about somebody else and how they approach their investment in this industry. The business of property investment kind of requires an element of creativity and resourcefulness. And there's no doubt in my mind that an entrepreneurial approach is the best way to go about unlocking the hidden value in assets. It's not just simply sitting back, buying an asset, and that's it. Now you have an investment that's going to produce the maximum return. There's actually quite a bit of operational work that can go in the background. And the more specialized you become, the more you can actually unlock that kind of value. As you're going to learn today, my guest clearly has those skills and traits in droves. Joining us all the way from Denver in Colorado, and specializing in an often overlooked asset class, that is self-storage facilities. Now, his name, Jacob Vanderslice. He is the co-founder and principal of Vanwest Partners, and they are a Denver-based real estate investment company. Whilst they have a broad range of experience across various asset classes, from residential to office and things like that, today they have gone all in and kind of decided to specialize in the acquisition, the development, and the management of self-storage facilities. And they've built a pretty impressive track record too, with over 300 million in real estate assets. They now own and operate 37 self-storage facilities across the continental United States. And in this episode, we're going to explore the ins and outs of that self-storage investment. How do you make the most out of it? And what are the opportunities, and what's the ideal market size? We jump into all that stuff. What you're going to really notice is the importance of operational efficiency and the strategies that Jacob and his team have used to create value in this niche market. And it's really interesting how a few little tweaks can make such a difference. So whether you're a seasoned investor or whether you're just starting out, I think there's going to be something in here for everyone. So without further ado, my conversation with Jacob Vanderslice. Jacob Vanderslice, welcome to the podcast.
Gavin, good afternoon to you and morning to me.
Yes, that's right. Yeah, you're in Denver, Colorado, and it's always fun getting somebody from across the pond on the podcast. And I'm not sure if you're familiar with this podcast, but we have quite an international audience that stretches to Australia and Singapore and South Africa. So it's a very broad. We also have a large following in the US. But for people who don't have any idea who Jacob Vanderslice is, why don't you give us a little intro to yourself?
Yeah, we're a private equity real estate investment company based out of Denver, Colorado, as you mentioned. And we've been investing full-time in real estate since back in 2006. And starting in 2015, we started focusing primarily on self-storage. We own 37 self-storage facilities. One of those is under construction, a variety of different target markets, Midwest, Southeast, Southwest here in the continental US. And we target deals that are just inefficiently operated and close on them. We add value by simply more efficiently operating the facilities. So growing rents, controlling operating expenses, and then eventually at some point in the future, we'd monetize that value creation.
Really interesting. And it's an area that I'm going to really drill down into today. I went on your website and I noticed you say that acquisition, development, management. So the whole, you're kind of in every aspect of it. And so we're going to drill into that. But before we do, I always like to kind of take my my guest back a little bit to the beginning of your career. Like, what brought you into real estate in the first place?
Yeah, I've always been interested in real estate and being an entrepreneur. And I can assure you, as probably the grass is always greener, right, on the side of being an
Yeah.
entrepreneur. Yeah, gosh, you don't work for anybody. You make your own schedule. Well, actually, I've got hundreds of investors and bankers and partners. So yeah, I'm self-employed, but sometimes that W-2 every 2 weeks, like we do it in the States, would be nice. But yeah, we got started doing single family fix and flips, and I had a lot of time on my hands. I was in the fire service and kind of deciding what I wanted to do. And I was on a ski lift with a family friend. And way back then, it was those Windows mobile devices
Yep.
with like the stylus and the cutting edge technology at the time. And we're on the ski lift, and he's on and off his phone coordinating a closing. And it was a deal he was going to sell and probably make some money. And I was like, man, that's pretty cool. This guy's on a ski lift and he's closing a deal today. How do I do that? So he gave me some ideas, and we started dabbling in the single family space and got busy doing that and quit my full-time job, and I've been unemployed since '06, for better or for worse. And for many years, we focused on just distressed residential deals. We buy them at the auctions. Here in Colorado, we call them the trustee sales. So you don't pay your mortgage, it goes to the courthouse steps. You buy the deal with a cashier's check. Did a lot of those. Did some townhome development, some multifamily value adds, some adaptive reuse retail. So buying old buildings, at least old buildings for Colorado, not for Ireland, but our old buildings here, are 120 years old. That's like new construction for you guys, probably. Um, and we reposition those into, multi-tenant experience-based retail, breweries, yoga studios, restaurants. We held some of those, we sold others. And leading up to 15, we were looking at the storage space, and we liked the fact it's been downside protected. It's got durable recurring revenue streams. We didn't know much about it though. And one thing we didn't like about our business in retrospect was our business was kind of overly transactional. We were buying and selling too often and too quickly. And we thought storage would be a good vehicle to kind of shift that thesis and that mindset to being more longer term holders. So did our first deal in 15. And at the time, it wasn't really an intentional strategic pivot to a new asset class. It was more just let's try a deal out and see what happens. And it went okay. We did some others, and over time, we evolved to being a self-storage owner operator. We do everything in-house. The only thing we outsource really is tax prep. We've got legal internally. We self-manage our entire portfolio. And property management's it's a painful business, as I'm
Yeah.
sure you know, but that's where so much of the value creation happens in real estate. It's just operating your asset base effectively. So yeah, that's who we are and a little bit of the backstory.
That's great backstory. And I mean, from given all of the experience you have and all of the different classes, the fact that you came across self-storage like just 9 years ago, and now your business is pretty much self-storage. Presumably that one deal you did in 2015 worked very well for you.
It actually, the first deal we did actually did not work well.
Oh, okay. Tell
We
me.
delivered it, and we learned from our, the failures feel like they happen yesterday, and you think about them almost every day. And the
Tell me about it.
successes you can chalk up to market timing, luck, right place, right time. So that deal, we kind of jumped in a big way. It was a big development project, basically in downtown Denver. And what we didn't appreciate at the time is the impact of new supply coming into a market. So self-storage is very local supply sensitive. So we had the idea to build this, and it turns out that a lot of people at the same time had the same idea. So a
Right.
bunch of deals came out of the ground, and the deal suffered for quite a while from a leasing perspective, from a rent perspective because of all the new competition. We also had an increase in our homeless population. We won't get into that too much. I could go into that for an hour. That's not why we're here today. But that drove some of our customers away. We had some people sleeping in units, which you're not supposed to sleep in a
Okay. Wow.
self-storage unit. Yeah, we're not a
Right.
multifamily operator, right? We're storage guys. Um, and eventually, even though the deal underperformed initially, we bundled that up into a portfolio of 8 properties, and we sold it to Extra Space in 2022 for a great return. So in aggregate, that first 8 deals, 9 deals actually that we did worked out well. But that first one had plenty of challenges, right? And
Right.
it's rare when you do your first deal of any kind. It's rare that it's going to be a home run. Sometimes it is, but we didn't know at the time what we didn't know. And I like to say we get a little less dumb every year.
Well, you know what? I've had the opposite experience, and I think the first deal not working is actually probably a good thing because I had a couple of home runs on my first deal, and it creates a false sense of security and a false sense of your own capabilities. You know,
Yeah.
if you get lucky, you suddenly think, oh, I know what I'm doing here, and you can end up stumbling into a much bigger deal that you would never have gone near had you not had the earlier success.
Yeah,
Um,
and sometimes that success, I mean, the last 6 or 7 years, really leading up to 2022, is kind of a great example of an era of kind of irrational exuberance, right?
yeah,
Not to say that you're smart or not smart, or I am or not smart, whatever the case is, but there's a lot of operators who may not be good operators and good executors who hit home runs during those periods. They might have
just
bought a
because
deal
of
in
the debt markets and
2017.
stuff. Yeah,
Yeah, the debt markets compressed. I mean, and you had the perfect storm of a very low cost of capital, compressing capitalization rates and rising rents. And all of those things happening together, you could have been way late on your project. You could have been over budget from a construction perspective, and you were saved and made to look heroic by those compressing cap rates and rising rents. And those days are over. So,
yeah,
for those of us listening, you evaluate different investment vehicles out there. Everyone talks about track record, and track record is certainly important. It's a data point, but track records leading up to 2022 really they kind of matter less than they ever have because
yeah.
everyone put up those, not everyone, but most of us put up those same returns back in those days. And now it's a different environment.
Yeah. How do you, yeah, exactly. And it's all about trying to articulate like how you're different from the crowd that everybody did it. A rising tide carries all boats, as Warren Buffett once put it.
That's
Um,
right.
Tell me this in terms of, I mean, I would not have considered, self-storage as a kind of asset class of its own. I'd sort of see it as a category of logistics. Would that be correct?
Yeah, it's kind of evolved into being more of a widely accepted asset class within real estate, but it's still kind of viewed as a subset of real estate
Yeah.
asset classes. But to respond to your comment about logistics, we are very much to a degree, we're almost a retail facing business more than we are a real estate investment company.
Right.
We have 90 employees. And we have hundreds of customers moving in and moving out every month. We have thousands of customers. And if you think about it, you mentioned before we started recording that you've leased a storage unit here and there in Ireland
Yeah, and
and
UK as well.
and the UK, yeah. So if you think about it, you guys have Starbucks over there, I assume, right? Yeah. So I'm not sure if you go to Starbucks or not, but you've probably been
Yeah.
a time or two. And if you go to Starbucks, you put in your mobile order, you walk in, it smells good, you got your barista there making your coffee, and you're kind of happy to be there. Like you want to get your coffee, you're getting your day started. In storage, no matter how good your circumstances are, you don't really want to be there. You don't want to go to your storage unit, even if you just got a new job and you're building a new house and you're getting a much larger paycheck. It still is not great to go to your storage unit. So you're dealing with people who are going through a lot of friction in life, right? And sometimes they're there for bad reasons. Maybe somebody passed away, maybe they got divorced, they lost their job.
Downsizing. Yeah.
Yeah, they're downsizing because they can't afford their current place. So having a good operations team that kind of understands the mentality of the customer is important. And our on-sites sometimes become kind of counselors to a degree. They don't want to
Wow.
be counselors, but people will kind of pour out their hearts and talk about the problems that they're going through, and they just want a pair of ears to listen to because nobody else will listen to them. So it's very retail facing.
Interesting.
The
Yeah.
other unique aspect of it as it relates to other real estate asset classes is all the leases are month to month. So our customers like that because they can have the flexibility to kind of come and go as they please. They're not
Mm.
locked into a long-term lease. But interestingly, most of them stay there longer than they thought. I'm not sure what
Yeah.
your experience was,
That was my experience.
But
Yeah.
yeah. I mean, you might have thought you were going to be there for 3 months, and 6 months or 9 months later, you're still there paying rent, and maybe they even gave you a rate increase. It kind of becomes out of sight, out of mind. You don't want to deal with your stuff. So the month-to-month lease is attractive to customers, but it also works from the ownership side because we can respond real time to supply and demand changes. We can do rate increases on higher demand unit types. We can do rate decreases on units that maybe have
Yeah.
low occupancy that we want. So there's really a lot of real-time levers you can pull in the business to drive revenue.
It's interesting. Yeah.
It's a unique asset.
One of the things that I wrote down is it kind of strikes me as being closer to the flex office market than kind of other type asset classes, because most of the time people are looking for some sort of a long lease to lock in a client. But with the flex office and with yourselves is that, it's month to month, but you can charge a premium because of that flexibility. And
You, absolutely, yeah. We have a lot of business customers too. Like for example, we have a few beverage distribution companies, so they stock vending machines, and they don't want to sign up for a 5 or 10 year lease on an industrial building, so they just lease a couple $100 a month storage unit, and they've been there for a long time, and they come and go, and they load and unload every day.
yeah.
So it's attractive to business customers sometimes too, depending on what your needs are.
My experience, I moved, spent a couple of years traveling, and I closed up my house in Ireland, and I moved to the south of Spain, and then I moved to the Middle East. It was actually post 2008, so there was a lot of, turbulence in the world economically and stuff. And so I decided, I'm going to go and put all my stuff into a storage unit, and I'll just, sell the house, and I'll just, I'll leave my stuff there. And after a year, I'll come back or whatever. And I can remember I needed a big enough storage unit that I could contain everything for the house. So it was like £3,000. It was €3,000 a year for me. And I kind of thought, oh, I'll do this for a year or two. And then I'll come back and I'll get a place, and I'll sort of everything will go back to normal. And what really sort of occurred to me is that you rarely go to the place except that it's like winter and you say, oh, where are my ski clothes, or something like that. And that's where they
Right.
are. And so I can remember the 10th year of using this thing. I can remember doing the mental arithmetic and saying, I have spent 30,000 on storage fees. Like I could probably buy a storage unit for this kind of money.
Yes,
And
or you
that's
could
when
have bought new stuff several times over. Yes. Well, you, sir, are our ideal customer.
yeah,
Yeah. If you don't complain, you pay on time, you've been there for 10 months. We did a case study in one of our portfolios, which is our third fund. It's got 11 properties, about 80 million in gross capitalization. We haven't owned the deals this long. But over 50% of our customers have been storing there for more than 3 years.
yeah.
So it's a very sticky customer base. A bunch of guys like you. I'm just going to be there for a little while, and they move, and they don't want to deal with their stuff, and out of sight, out of mind. It hits that bank account auto draft every month, and it annoys you for a minute, but you don't do anything about it.
Well, the thing is it might annoy you, but what are you going to do about it? It means a day of, clearing it out and then having to find somewhere else to put it. And so
Yes.
there's so much inertia there, like that most people will just say, I'll deal with it when I have a bit more time.
Yeah, I personally have a storage unit that I thought I'd be in for 2 or 3 months, and it's probably been 15 or 16 months now, and I have not found the time to go deal with the stuff.
Yeah, like my. So anyway, Jacob, let's move on in terms of acquisition. I mean, so you're buying these units, and you're based in Denver, but you mentioned that there's various parts around the U.S. that you're buying. I mean,
Yep.
what would you say? What are the population stats that kind of make like? Would you be looking for? Is there an optimal size city or that you would be looking to buy inside of, or tell us
Yeah.
some of your, how
Yeah.
would you identify a good deal?
I'll spin you through some of the metrics that we look for. And a lot of these are just kind of standard real estate fundamentals, right? You want a story for population growth. You want a story for growing wages. You don't want a place that people are net moving out of. You want net positive migration, not net negative migration. But one of the first things we look at is just rooftops. We don't want to buy these deals in overly rural locations, and obviously the reasons there, you don't have the demand. You're more impacted by new supply. If somebody builds a new facility in a tiny town you're already in, your supply ratios are going to get way out of whack. So we focus in markets that have rooftops and housing density. As it relates to self-storage, though, one of the main things that we look for is the supply ratio of that market. And the supply ratio is expressed, and I know we're one of the only countries in the world that's still on the old English system, but square feet per capita versus square meters per capita. So how many square feet per person have been in this submarket historically? And nationally, there's about 8 square feet per capita of self-storage in the States. And, historically, you might say that if you've got a submarket that's well over that, you might say you're oversupplied, and well under that, you might say you're undersupplied. But we look more at what the historic supply ratios have been. So maybe this market's had 30 square feet per capita of storage for 10 years, which seems like a really high supply ratio. But all the facilities, or most of the facilities, are maybe at 90% plus occupancy. So that's a market that can support higher supply ratios. So as we're diving into supply ratios, what we're looking for is, has there been a recent supply shock? We touched on our first Denver deal, way back in 2015. We didn't open it until 2016, but we've seen what supply shock can do. So are there 10 facilities within 5 miles that are under construction that are all going to deliver within a year from now? So that's the main risk profile of the asset class, is just that supply, that the risk of new supply and supply shock. So we do everything we can subjectively and objectively to defend against the possibility of new supply. We look at zoning code, we look at building permits. We'll send our team out to, let's say we're getting a report that says this deal's under construction. We'll go verify visually if they're actually moving dirt. And in the last 6 to 12 months, a lot of these deals that we see that are supposedly under construction, we show up to and nothing's happened. And that's obviously a function of equity tough to get, debt, elevated hard costs. So we're looking at supply first. And we also look at markets where we can get some geographic concentration. We'll do a singular new deal in a new market if it makes sense. But if we're going somewhere new, we want to believe in a story to be able to add more assets to that submarket. And as you kind of grow in size within a given geography, you can amortize your fixed costs more effectively across a larger asset base. So you might hire a regional manager, for example, for that market, and that person can run 6 deals. So their expense load is amortized across 6 deals versus 2, and it benefits all 6 deals, whether they're in a single asset syndication vehicle or in a fund portfolio. So we like to find places we can get some geographic concentration and scale to. It's not a requirement. But yeah, supply ratios, good demographics, rooftop density, and we want the ability to add more to our asset base in that given location.
That's interesting. And one of the things that I want to just differentiate and touch on, I noticed when I looked at your website that it seems like they are kind of like open areas with single floor storage units that look a little bit like, for our listener, a little bit like, own door garages, basically, for, if you wanted to park your car, you could have, 20 garages in a row or something like that. That's what it looks like. And my experience in the UK and here in Ireland was quite different. I found that when I went to London, I rented a place, and London, the rents are very high and the apartments are very, very small. And so I had a lot of stuff that I just could not find a space for without having, it stacked in bedrooms and stuff. And so I kind of said, okay, let's go and find a storage unit. And as it happens, there was one just the end of the street, but it was in an underground car park. And it was actually, the car park operated in the first 2 floors, but then there was another lower 2 floors. And that's where the storage guys had gone in and filled it with these kind of own door units. And so I was interested by that. I was kind of, oh wow, that's different to how I would have imagined. And then here in Ireland, I've been a customer of 2 different ones, and they both go and they rent a big shed, big logistics warehouse or something like that with the big high eaves, and they'll go and they'll put in maybe a mezzanine, and they'll have upper floor and lower floor storage units. And so, I mean, that's the thing, that when I saw yours, it looks to me like they're purpose built as just a storage unit. It's not sort of like repurposing some other asset.
Yeah, I'll spin you through the different building forms that we do. And we have done a handful of conversions over the years from a non-storage use to a storage use. We converted a multi-story office building here in Denver, Colorado years ago into storage. And that was a complicated project, to say the least. And, one of the surprises on that one, not surprise, we knew this going into it, but what I didn't know, leading up to this was the floor loads on office are materially lower than the floor load requirements for storage. So how do we solve this? Well, we got a bunch of guys with carbon fiber paper mache, and they basically put in this carbon fiber in the structural members. And you look around, it's like that really brought the floor loads up to 100,
Wow.
120 pounds per foot from whatever it was, 50. And we also repurposed a number of industrial buildings too. Big clear span industrial kind of lends itself well to storage. You've already got four walls. You throw in a bunch of storage units, you put a new roof on, some HVAC, and you've got a new storage facility. Most of our deals, though, have been built for self-storage as a primary use.
Right.
And we've got a few different types. We'll have a lot of deals that are single story, drive up climate and non-climate control. Maybe 2/3 of a given deal is drive up non-climate, and then a couple buildings on it are drive up climate control. We can charge a little bit of a premium for climate control units depending on the market. And we also will occasionally do multi-story facilities, and we don't have any markets that are nearly as dense as London, obviously one of the most dense cities on the planet. But in our more dense infill locations, we'll do multi-story facilities. We're building one right now in Southeast Denver that'll be done in probably February, which means, May, right? That's always how it goes.
Yeah.
And that's 5 stories, elevator accessed, and it's got 1,000 units.
Okay.
So we really will target our acquisitions or our development deals kind of based on what the market wants. You're not going to go out to the suburbs, for example, in a less dense population center and build a 5-story building. And the reason you're not going to do that is if people have optionality, they don't want to go ride an elevator, push their cart 100 feet down a hallway, and then rinse and repeat as they load and unload. They just want to show up to their unit with their truck, put their stuff in and leave. Unless they don't have any other options. So we'll do this occasionally, but most of our deals are drive up.
Yeah, no, that's a great. It's funny when you said the moment you said it, I was like, that's the perfect description of it. You can just reverse your car right up to the door, and that's it. I remember in my case, I used to have to go in, unload my car or my truck, and I would put it all onto a kind of a trolley, and then have to kind of push it over, and you'd have to kind of bring it in, and then put it onto kind of a lift, and the lift would go up, and then and it was. Yeah, there was a lot of work in that. So I can understand now exactly why. The only reason, I guess, no, I haven't seen anything in Ireland yet, and other markets I've not really looked, but I haven't seen any drive ups. And I guess the reason is that when somebody takes a shed, an industrial shed or something like that, and converts it, at least if the business doesn't work, you can just go back to the use as a shed. Whereas if you build a load of drive ups, and the market hasn't been proven, you've got something that isn't really of great use to anybody else.
Right. Yeah, we if one of our deals, let's say eventually storage didn't work there anymore, a lot of our properties are on quite a bit of land, sometimes 5 acres. Okay. So there's intrinsic value in that land. Obviously, you could have another use. You could build an office building. Office is a bad example, but multifamily, retail, whatever the case might be. So there's always a plan B in real estate if your plan A doesn't work.
Yeah. And do you have like a critical mass? You mentioned the 5-story one is 1,000 units. I mean, how big would your deals normally be? Or is there?
Yeah, it's not. Size? We typically express that minimum size in square footage and dollars.
Okay.
So the unit count, it's a data point, but some markets want a larger average unit size than others. The more suburban locations, maybe they want an average unit size of 200 square feet versus 75 or 80 in a downtown infill location. But if we're going to a new market and buying a new deal that we're not already operating in, that deal needs to be probably at least 40,000 square feet, maybe higher, and at least $4 or $5 million in total capitalization. That's a lot of money, obviously, to you and I. But as we can all probably appreciate, it takes as much time to do a smaller deal as it does a big deal. Sometimes more time. It's still the same loan. It's still the same third-party reports and contract negotiations. So we'll definitely shy away from doing anything that's smaller than that. If it's somewhere we're already operating in, and there's a good business case to add a smaller deal to maybe something we own that's 5 miles away, we might do something that's lower. But I would say, minimum kind of sweet spots about 40 or 50,000 square feet, and
Right.
all in at 4 or 5 million. And I would say our average deal size in dollars is probably 7 or 8 million, somewhere in there in total basis. And that's, probably square footage around 60,000, maybe 70. And our biggest one we have right now is that development project that's only about 80,000 square feet, but it's all in at about $25 million.
Okay.
So it's a bigger basis deal. It's pretty rare that we'll do a singular deal that's that high in total dollar cost basis.
And are you
So
in that market already?
yeah, well, it's we love our hometown and our home state,
Yeah.
Colorado. And unfortunately, a lot of the deals we do are not here just because the market doesn't make sense. It's hard to find stuff that makes sense. So we only have 3 deals in Colorado, and we had more, and we sold those off back in 2022. But this deal is one of the 3, and it's about 10 minutes east of our office. So we know the market well.
Yeah, I was just thinking that if you're going to go that much bigger than your average, then you must know the market pretty well.
Yeah, well, we'll see how it goes. The risk on these, if you're building a new project, you've got construction risk and timeline risks and all that, but we mitigate those pretty well with contingency, and we put a lot of fluff into our construction budget. So it's got to be pretty bad if we exceed that. But the risk in these is all in the rents and in the lease up.
Yeah.
In our industry, we express rents in dollars per square foot per month. And let's say we're targeting stabilized rents of maybe $2 per square foot, and we come in at $1.80. That's a material change. It's only 20
10%.
cents, but you amortize that across a bunch of units, and you put a cap rate on that, and you could have a material decline in your overall project performance with a tiny little miss in rents. So that's where
Wow.
the risk is the revenue side for sure.
And that's why I guess the fact that you specialize in this, you guys have become experts in it, and a new entrant into the market wouldn't know those nuances necessarily, and they could go in and make a big mistake very easily.
Yeah. Really depends on the operator. There's some large operators here in the States that are called REITs. Examples are like Public Storage, Extra Space, CubeSmart. There's some of the bigger ones. And they certainly know what they're doing, but they're not entrepreneurial, right? They're
Yeah.
not watching their expense loads like a shop like ours is. So even if a REIT does build a facility near you, you might still be able to outperform them and still attract customers because you're not smarter than they are for sure, but you're probably paying a lot more attention than they are.
Mm.
Uh, but yeah, it's never, we can probably operate it more efficiently, but it's never something that we're excited about if somebody's building a competing store, within a
Yeah.
mile of one of ours. Yeah.
And on that basis, like where do you find your deals? Are you buying them from existing operators that are just, not managing it correctly and can't seem to make sense of it? And you step in and you bring some management skill to it?
Yeah, we about 70% plus of our deals are off market, and that's a phrase that I use very cautiously because off market means a lot of different things to a lot of different people.
Yeah.
But these are truly not marketed. There's a broker involved. We spend a lot of time building and maintaining broker relationships. They'll get a listing and they'll give us guidance on pricing, and they'll bring it to us first because we closed their last 2 deals with no trouble. They just want to get paid their fee, right?
Yeah.
And that's where most of them come from. And our seller types really, sometimes it's somebody who kind of fell into the business and they maybe
Mm.
own 2 or 3 facilities, and they're 95% occupied, and they've owned them for 15 years, and they don't view that there's a lot of juice left to squeeze out of that deal. And we'll identify it and we'll see, gosh, well, their rents are below market, their occupancy is too high because their rents are too low. And we see a path to growing revenue pretty substantially in the first 2 or 3 years of operations. So our sellers are by no means unintelligent. They're just not maximizing revenue. We do see some distressed sellers here and there, people with maybe a floating rate loan maturity issue or a partnership dispute. And then we just see generational changes, right? Parents get older,
Retire, yeah.
hey kids, you take over the storage facilities, you guys run these and they're yours, and the kids decide, man, I'd rather walk with 10 million in cash than deal with all these storage customers. And
Yeah.
they just want a quick solution to a sale. So a variety of different seller types. But I would say by and large, they're generally um, less sophisticated and not maximizing their revenue.
You mentioned something there that immediately came, pointed out in my mind. The 95% occupancy indicates to you that there's a problem with the rents.
Yeah,
So
it's kind of counterintuitive
it
because you
is,
would
yeah.
you would
I'm
think, gosh,
curious.
where's the value creation on a deal that you're buying at 95%? Are you just paying par for this thing? What are you going to do? Well, in self-storage, if you're too full, it means your rents are too low. And what we'll often do after we close in a new acquisition that's got high unit occupancy is we'll drive down unit occupancy while driving up revenue. And how are we doing that? Well, we're increasing rates on existing customers that are below market. You might have a guy like you who's been there for 10 years, you probably saw a rate increase, but maybe you didn't. It's like, man, this guy's been there for a long time. He's sticky. He can probably withstand another $20 a month in a rate increase and probably not move
Mm,
out. And again, 20 bucks doesn't seem like a lot, but you amortize that across thousands of units, you annualize it, you put a cap rate on it. It's a lot of value creation. So what we're endeavoring to do generally is driving up economic occupancy versus physical. And we're still trying to drive up physical, but economic is purely, what's your in-place revenue as a percentage of your stabilized revenue if everything's full. And often we'll drive down our unit occupancy while driving that up. So we have a deal, for example, in Green Bay, Wisconsin. We bought that property at unit occupancy in the low 90s last June. And a year later, our unit occupancy is still in the low 90s, but we've increased revenue by about 20%. And
wow.
we've done that by increasing rates and also ancillary income streams. I'm not sure what they do in Europe, but in the States, there's a lot of ancillary income and storage, and one of them is tenant insurance.
Oh
So
yeah.
in the customary self-storage lease, it states that we as the owner are not responsible for fire, theft, flood, whatever might happen to your stuff. It's not our fault, even though we're the building owner. So we require our customers to either present proof of coverage on their homeowner's policy or buy what we call a protection plan from us. So we'll charge our customers anywhere from $15 to $25 a month, and we'll pay our carrier $2 a month per unit. And
Wow.
that'll cover their contents up to a certain amount. And between late fees, tenant insurance, merchandise sales like boxes and tape, we also have some truck rentals where someone can rent a moving truck. Those income streams comprise about 13% of our top line revenue.
Wow.
And most of the sellers we buy these deals from don't have all those in place. So there's a value creation lift without doing any inordinate amount of work on the operations side. You can raise your revenue pretty substantially in the first year
Yeah.
just by bringing some of these ancillary income streams into your deals.
Well, it's really interesting. And tell me, like, is there a level that you would say, oh, our rents are too high? I mean, if it was to fall back down to 85 or 80, like, where's the sort of collar between the upper and lower?
Yeah, it's a fine balancing act between economic occupancy and unit occupancy. But I would say it just kind of depends on the numbers. But if you're dropping below 80, maybe into the mid to high 70s, then you're like, okay, maybe we push this a little bit too much. Let's drop our rents back down. Let's start to advertise more. It just kind of depends on the deal. But you
Gotcha.
might have achieved your pro forma economic occupancy with unit occupancy still in the high 70s or 80s. So you still feel good, but then you're like, okay, how can we squeeze some more value out of this? But yeah, that threshold kind of varies from deal to deal.
Right. Interesting. And in terms of the way that you buy, I mean, obviously the way that the guys that I've worked with before, these other operators, they the fact that they're in a big warehouse or a shed, they're probably renting it themselves and then sub-renting out to, the customer. Um, Presumably you're only interested in the acquisition of the entire asset.
Correct. We've underwritten a few deals over the years that are, as you described, where you would rent the building and then, lease the building out, and you'd arbitrage basically, your rent versus your income. We haven't done those before though. So everything that we own is fee simple. So we're on the deed to the property. We own it. We would consider doing something like that in the right set of circumstances, but it's a pretty drastically different set of risk profiles and return profiles when you're renting the space versus owning it, especially from the tax side, right?
Mm.
You're missing out on a lot of the depreciation. You can depreciate certain components to it that you might buy for the building, but you don't own the real estate, you don't own the building. So it's definitely a different business plan, but we have looked at those before. We just never done one.
Okay. Yeah. Yeah, I was just curious about that. And in terms of, development, are you buying in, industrial zones and you're building, or are you buying unzoned land and going through the process of getting it zoned and things like that?
Yeah, we're doing both, but I don't want to say never, but we might do this at some point. But historically, we've never closed on a property on a development deal that's got entitlement risk. So if we're targeting an acquisition, development project acquisition that's not zoned for storage, we're getting the runway on our contract from the seller to work through that entitlement process. The last thing you want to do is buy the land quickly and you go to the city and they're resistant to changing the zoning. You got a
Right.
big problem if that happens, right? Then it's plan B, C, and all the letters down from there. You don't want to do that. So yeah, we're getting our entitlements done before we close. And if we close on a deal quickly, we have a project north of Denver that we opened up in December of last year. It took about a year to build it. That one was already entitled and it was a use by right. So we felt comfortable closing on the land acquisition a bit faster. And the $25 million project I mentioned to you a few minutes ago, we were in entitlements on that project for close to 2 years. So we had
Wow.
it under contract, spending money on design, working our way through the city, and we closed on it when those entitlements, the risk of those were gone. So it really varies from deal to deal.
Interesting. And I was interested when you said that did you say you have 90 staff or employees?
We do.
And yeah, because I was thinking about in terms of 37 units, 90 staff, it's averaging kind of like three per unit or something a little bit less than that. Because when the experience I had, the last place that I worked at, or that I used was very much automated. You walked up to a door and there was a keypad, you could let yourself in, everything was CCTV. So presumably these places, apart from the sales process of getting somebody to sign a contract, after that, it's pretty much, you know, user friendly, just
Yeah, I'll speak to that for a moment. So, very roughly, of our 90 employees, about 70 of them are on our operations team. They're our on-site managers. They're the folks behind the desk in the leasing office at the storage facility. About 20 of us here are in our Denver office, our controller, our underwriting team, our operations team that's here in Denver. So, as far as the automation component goes, we experimented with this back in 2019. And we tried to run a number of our facilities without any on-site staff, so completely automated. And other operators have figured this out, and they've made a lot of leaps and bounds towards completely, remote managed sites. But we could not at the time. We couldn't figure it out. And some of the challenges that we encountered were bad things happen when a person's not there, right?
mm,
And that customer experience can kind of erode. Maybe the unit that you just leased, you walk up to it and the door's open and somebody's stuff is in there still. Well, what happened? And if there's not a person there to resolve that, you've got a deterioration in the overall customer experience.
yeah.
So with that being said, most of our facilities are staffed. We do have a few satellite locations that are not staffed, and maybe they're a mile away from like a larger facility. And you come to that leasing office, you lease your unit, and you drive over. But all of our deals, our customers have the option to complete the entire leasing experience without ever talking to a person. They
Okay.
can make their payment
Online.
online, sign their lease online, get their gate code. And I do my Starbucks mobile orders because I don't want to wait in line. I love people, but I don't want to talk to a person if I can avoid it because I'm busy. And a lot of our customers want to do the same thing, but they do have the option to go to our on-site team member to address any issues they might have. And to your point, the sales process, they can sell the tenant insurance a little more aggressively if they're in person. Hey, you got to get coverage. It's just easier to buy it from us than go dig up your homeowner's policy. You're only going to be here for 3 months. Why not just buy it from us and not worry about it? Hey, do you need some boxes and tape? They're on sale, 50% off. So there's some salesmanship there too. But
Yeah.
people can lease anytime from us, move in, do everything online or on their smartphone. But they do have the option to talk to a person, either on site or via our call center.
And I'm curious, I mean, in terms of, in banking, they have the know your client and all that kind of stuff. What do you have to have any kind of checks on the stuff that's being stored, or is it completely blind to you?
Yeah, it's mostly blind. In our lease, it stipulates the types of items they can't store, like explosives, drugs, anything bad. But once their stuff's in the unit, the door's down, and we're not opening up our customer units unless we have a reason to.
Yeah.
With that being said, though, I guarantee you, there's plenty of nefarious things being stored in our portfolio right now that we're not aware of, and not infrequently, actually, we'll get served warrants from the government with like drug related cases. Like, hey, here's a search warrant for Unit 203 in Oklahoma City. Of reason to believe this guy is storing drugs in there of some kind. So our leases say don't put stuff like that in there, but people definitely slip through the cracks, and that's the
Yeah.
case with our portfolio. We're a medium-sized operator, all the way up to Public Storage and Extra Space, which are the two biggest in the world.
I'm thinking of that scene in the series Breaking Bad years ago, and he was storing
Oh yeah,
$80 million in cash in his storage unit.
yes,
And then he
yes.
gets shot dead or something, and so it's sitting there in one of your units. You're
Yep.
unawares that
Yep. Yep. I can't imagine we have that much cash in one of our units right now, but I bet in one of our units somewhere there's a bunch of illicit cash of some kind.
probably. We're coming near the end, Jacob. But what I wanted to just touch on is you mentioned syndication or fund portfolio. So I'm curious, what is the kind of the typical ownership structure in your business there?
Yeah, yeah. In the U.S., if you're investing in a private placement, real estate investment vehicle, there's generally kind of two different deal types. One is a single asset deal, which simply means that the sponsor is forming an LLC. They're raising capital for that one specific project. You're investing into that project. You've got membership interest in the LLC, and your distributions come from that one property. A fund structurally is generally pretty similar to a single asset deal, but a fund, as you might infer, is a collection of assets. So if you're investing in a fund, you might liken that to buying a mutual fund in the equities market versus buying a singular stock, which is kind of like investing in a single asset syndication. Um, we put most of our deals into our fund vehicles. We're in the process of being very close to closing down Fund 3. We bought our last deal last year, and we're kind of winding that down. For the rest of this year, we're going to be doing more deals. Of course, we're not stopping anytime in the foreseeable future. But we just don't see a story for kind of justifying launching a new fund vehicle because deal flow is still very, very tough.
Right.
It's really tough to find stuff that meets our fairly rigorous risk-adjusted return requirements. So the offerings for the rest of 24 will likely be single asset deals, and we'll probably launch a new fund next year, kind of depending on what the world does. But really, the advantage to a single asset syndication is you can pick and choose where you want to be from a geography perspective. Maybe you like North Carolina, but you don't like Florida. The fund you're in might buy in Florida, and you don't want to be there. And we'll certainly listen to you, but there's not much you can do
Yeah.
as a LP to kind of dictate where the fund's going. Whereas in syndications, you can kind of pick and choose where you want to go. But the downside of a syndication is if the deal doesn't perform well for whatever reason, there's no other sources of cash flow to kind of shore that up. Whereas if you're investing in a fund vehicle, maybe the fund's got 15 properties, and in a given quarter, for whatever reason, two of them are lagging forecast. Well, those don't really hurt the fund because they're balanced out, say, by the other 13 properties that are
Yeah.
on or ahead of forecast. So,
Diversification. Yeah.
yeah. So if you end up buying a dog, which we certainly don't intend to do, and frankly, if you do want a dog, you probably don't know about it for quite a while, right? It takes a few
Yeah.
years to figure out it was a bad deal. But if you do end up with kind of an underperformer, it's balanced out with the other deals that are performing, whereas syndications don't have that benefit. So those are kind of the basic differences. We do both, and there's a time and a place for both. But it kind of just depends on the preferences of the investor.
And in terms of what you're sort of offering an investor, is it an income play? Are you adding, talking about a capital growth story with an exit in 5 years, or what's your typical kind of offer?
Yeah, it's a combination of both. It's a cash flow play and it's a growth play. In this environment, the last 18 months or so, just given what interest rates have done and the fact that pricing hasn't really eroded that much, most of our deals that we bought are heavier value add. They've got a heavier lease up component, a heavier capital improvement component, and obviously the cost of our debt is materially higher than it used to be, so our leverage is lower. So lately, our deals have been very light cash flow, kind of by design. But our target's always cash flow. That's really at the core of our investment thesis. We like durable recurring revenue streams. But the path to that cash flow can vary, right? If you're doing a development project, you're not going to have cash flow for years, obviously. So it's kind of a combination. Generally, though, as far as hold periods go, depending on the deal type, we'll underwrite a hold period of 5 to 7 years. That's not set in stone, though. Nowhere in our documents does it say we have to sell it in the 5th year or the 7th year. And sometimes we'll sell a lot sooner, and sometimes we'll strap in to hold longer. Yeah, just kind of what's the market bearing. We sold 6 deals in the last year, and the latter half of those deals, about 3 of them sold in Q1 and Q4, Q1 of this year, Q4 of last year. And we had underwritten those deals for a 7-year hold. And the first one that sold was 2 years, and the second two that sold were 2.5 years. So it's kind of balancing. We don't intend to sell quickly, but there's a return profile that we can realize that's faster. And that return profile might be similar to what we thought we were going to get in 5 years from now. Well, it might make sense to monetize. So generally 5 to 7 years, and we're targeting IRRs in the mid-teens and multiples in the low twos. But all of those targeted returns, by the way, are wrong. Right? The model never goes exactly like you think it will. It always goes better or worse, hopefully more often better. But we're making assumptions on values, interest rates, cap rates in years from now. And your guess is as good as mine where cap rates are going to be in 2029, right?
And if you're exiting, are you exiting to the like the bigger operators that you mentioned, the REITs and stuff like that? That's the exit strategy for you?
Yeah, we haven't we sold that 2022 portfolio to Extra Space. They're obviously a large REIT. And most of the deals that we sold of our last 6 were sold to larger operators that are bigger than us. They're actually publicly traded REITs, but they're bigger outfits. They have a lower return threshold, a lower cost of capital. And sometimes we'll sell deals to just smaller operators. We sold a deal in Des Moines, Iowa, to somebody that's a lot smaller than we are, and it just made sense. But for the most part, you're targeting buyers that are larger operators with a bit of a lower return threshold.
And in terms of, would you have a typical investor who's coming in? Like, what does that profile look like?
Yeah, it really runs the gamut. We've got horse jockeys, we've got small business owners, we've got dentists, entrepreneurs. We have large institutional partners that have billions of dollars under management. We have ultra high net worth family offices, CEOs of publicly traded companies. So it's a pretty wide berth.
Wow.
Some folks will invest 25 or 50K with us, and others are tens of millions. It kind of varies by deal.
Wow. Interesting. Jacob, I'm looking at the time. We're coming up on an hour or so. What I'd like to do is just give you an opportunity to say if anyone would like to learn more about your business or about you, what's the best place to find you?
Yeah, we always love to connect to talk about real estate, and certainly if you have a storage facility that you've heard about that looks attractive or that's for sale, we'd love to hear about that too. Folks can reach out to me. My email is jacob@vanwestpartners.com. They can go to our website, vanwestpartners.com, or hit me on LinkedIn.
Yeah, I'll do that. I'll put those details in the show notes, and I must connect with you on LinkedIn so that when this goes live, we'll tag you. So, Jacob,
Sounds good. We'll do the same.
I'd like to thank you for your time and really interesting conversation, and wish you the best of luck with your business.
Thanks, Gavin. We appreciate it. Thanks for making the time.
All right, guys, I hope you enjoyed that conversation with Jacob. I hope you found this deep dive into the world of self-storage investment interesting. I certainly did. I got a lot of valuable insights out of it and how to successfully navigate this asset class. And as soon as I was finished the conversation, I started thinking, I wonder how much value I could find in this market, and started, looking into it. So it always pays to kind of look and think outside the box. And so anyway, from understanding market dynamics to enhancing operational efficiency, there's a lot we can learn from his approach. And ultimately, we all have to remember that success in real estate, like in any venture, really requires like continuous learning, adaptability, and resourcefulness. And so until next time, keep exploring, stay curious, and take care until I see you next week. Thank you for tuning in to another episode of Behind the Facade. If you enjoyed the show or found it in any way useful, could I please ask you to take a moment to leave a review over on iTunes or Spotify? This really helps us get the podcast out in front of more people. If you have any questions or topics you would like me to cover in future episodes, please connect with me via my brand new school community. You will find a link in the show notes. You can stay up to date with all of my content and the projects I'm working on by signing up for my weekly newsletter over on my website, gavinjgallagher.com. That's all for now. See you back here, same time next week.